Kangas offers 31 flavors of ice cream, and that's a lot of choices. But how do you choose between 4,500 mutual funds? Stay tuned for some answers.
This is a special edition of the Nightly Business Report, How to Invest in Mutual Funds, with Paul Kangas and the NBRT. Nightly Business Report is made possible by Digital, doing whatever it takes to make information work for people, and not the other way around. Franklin and Templeton Worldwide form the more than $115 billion Franklin Templeton Group, a global alliance of mutual funds and investment products distributed by investment professionals. A.G. Edwards, helping to build your financial future with comprehensive trust and estate planning services. A.G. Edwards, serving investors for more than 100 years. And is produced in association with Reuters, which provides real-time and historical market data, news, and analytics over Quotron Advantage AE.
Perhaps you've got some money to invest, but you don't know where to begin. If you put your money in the bank, you'll be lucky to stay ahead of inflation. You could buy shares of a certain stock or a corporate bond, but one bad earnings report and you could be stuck with a major loss. For that reason, one of the cardinal rules of investing is never to put all your eggs in any one basket. That's where mutual funds can help. When you buy a mutual fund, you're essentially joining with other investors to buy an assortment of stocks or bonds and thereby spreading the risk. At the same time, you're hiring a professional mutual fund manager. It's his or her job to constantly monitor the stocks or bonds in the fund's portfolio and to change the mix when necessary to maximize your return. The only problem is, picking the right mutual fund is not an easy task. In this program, we won't tell you which fund to buy because that depends on your personal circumstances. But we will tell you about the different kinds of funds that are available, how to evaluate their performance, and other factors you should keep in mind before you put your hard-earned money into any fund. Although many people are just discovering mutual funds, they've actually been in existence for some 7 decades. Greg Stone reports on 2 Boston-based funds that have been around since the start.
A lot has happened in the investment world over the last 7 decades, and 2 funds have seen it all. Massachusetts Investors Trust, founded in 1924, the nation's oldest mutual fund, and State Street Investment Trust, the second oldest, by just 2 weeks. The original idea was to pool resources so the small investor could achieve instant diversification and could benefit from professional management.
I think it was a major radical notion. Nobody, it doesn't sound like a big event, but nobody had ever thought of the small investor and having it be freely tradable. And I would just suggest that nobody even thought it would be a successful concept.
Why was Boston the birthplace of this revolutionary new idea? For one thing, there was a legacy from the seafaring days of the last century when ship captains who spent long periods on the water entrusted their money to managers for safekeeping. Or maybe it was just that people felt comfortable with Yankee conservatism. In fact, State Street has essentially had only 3 managers in its history. And for the last 41 years, the Bennetts, father and son, have been at the helm.
We never bought a stock unless we called on the management first and decided in our own mind that they were competent, able, honest, and interested in the shareholders.
With funds that have been around so long, there is an emphasis on long-term investing, meaning 5 years or more.
Because you can get caught in a short-term downdraft in markets where, in fact, stocks do go down. The fund is probably going to go down in value. But if you take a 5-year view, I think you'll be well rewarded if history is any guide. In fact, there is no 5-year period in the last 50 years we would have lost money in State Street Investment Trust.
If you had invested $10,000 in the fund back in 1924, and you reinvested all the dividends and capital gains, you would have had over $42 million as of the end of last year. And at Massachusetts Investors Trust, or MIT, you would have had $4.5 million. Why the difference? For one thing, MIT had been more conservative, particularly in the early years. What's more, State Street was closed to the public for 45 years and therefore was not subject to the same level of redemption charges and other expenses.
On a down tick or up tick?
Up tick. Zach's is looking for 28.
The road has not always been smooth. Yet depression or prosperity, managers agree that one ingredient does not change.
Judgment is the main thing. I don't believe there's any mechanical way to make money by pushing figures around without using judgment. History is the best guide to the future, but you can't depend on it too much.
Greg Stone, NBR, Boston.
As I noted earlier, when you buy a mutual fund, you are essentially buying into a pool of stocks or bonds. So how is the mutual fund's price determined? Through a number called its net asset value, or NAV. Net asset value is simply the number of shares sold by the fund or its assets divided by the value of its holdings, the cash, stocks, or bonds that it holds minus fund expenses. Because stock or bond prices are constantly changing, a fund's net asset value is calculated after the stock market closes for the day. At that time, a computer determines how much the various stocks and bonds held in the fund are worth and translates that into the NAV for each of the fund's shares. The number is in dollars and cents, so you don't need any special training to read it. If you want to check the NAV of a particular fund, it's usually listed in the financial section of your daily newspaper. You'll find it under the name of its sponsoring company or fund family. As we noted earlier, maximizing your fund's return is the job of its portfolio manager. But just how does a typical manager go about doing that? We sent New York Bureau Chief Scott Gervey to find out.
By the time Dick Hoey walks into the Manhattan headquarters of the Dreyfus Corporation, about 7:30 in the morning, he has already scanned the financial pages of 5 newspapers. A quick check of the quote machines is the first order of business.
I think Japan did well overnight, and Europe did fairly well overnight. So.
Hoey is manager of the Dreyfus Growth and Income Fund. The fund began trading at the start of 1992 and within 2 years grew to more than $1 billion in assets. During that period, its rate of return was more than double that of the S&P 500. Hoey is also Dreyfus's chief economist. It is an unusual combination, but one Hoey says is a benefit to a manager practicing his kind of investing strategy.
Okay. The way I invest is basically sector switching and thematically, because I'm doing top-down. So I won't tend to buy an individual stock because somebody tells me that there's some good piece of news.
Hoey's first meeting of the day is a briefing on the Japanese market. From that meeting, it is time to visit the trading floor as the market opens. Hoey talks throughout the day with the people who do the actual buying and selling for the Dreyfus Fund. On the way back to his office, there's a quick stop to see the boss, Howard Stein, chairman of the Dreyfus Corporation. Back in his own office, it is time for Hoey to field calls from the brokers for initial public offerings. Fund managers are pitched dozens of new offerings each day. Suddenly, there's a call. The manager of an offering Hoey has been considering says the books are closing. Hoey has 10 minutes to make a decision. He picks up his line to the trading desk.
If you could put me in for $10 million, I think it's a $100 million deal, and they're moving towards closing the books on it.
Today is the day of the weekly staff meeting of the company's senior staff. The discussion over lunch runs around the table, and analysts, fund managers, and traders offer their perspectives on all the markets. The afternoon will be spent attending meetings with companies and investment bankers, bringing new issues to the market. The day ends with a final review of the market close, and within an hour or two of that time, the fund will post its net asset value for the day, a daily measure of fund performance.
You pick up the paper, and you either got an A, or you got a C, or you got an E. You know how you've done that day relative to what you're trying to accomplish.
Remember, you judge the performance of a mutual fund and that of its manager by seeing if the fund's value rises more than the market averages when the market is up and falls less than the averages when the market is down. Scott Gervey, NBR, New York.
Now that you've seen what a portfolio manager does, should you take his or her track record into account before you buy a fund? And if a fund's manager leaves, should that be your cue to exit? We pose those two questions to two experts.
When we say that the manager is critical, if a manager has left and trained a new manager in the same style and philosophy and is consistent, we would stay. In fact, we do avoid star performers. We're not looking for stars. We're looking for consistency.
You have to understand that there are 3,000 to 4,000 funds out there for choices, and so you have many choices, and you should not fall in love with your manager. You shouldn't place his picture on your nightstand and, so to speak, pay homage to it each and every night. That you should just simply take that as a chance to review where you stand with that fund.
As I noted earlier, there is no shortage of mutual funds from which to choose. In fact, with more than 4,500 funds available, the selection can almost be overwhelming. To help you through this dilemma, the first thing to remember is that most funds fall into one of three broad areas: equity or stock funds, bond funds, and money market funds. Once you've decided which of those areas most interests you, the next step is to narrow down to a subcategory or group. For now, let's look at 4 groups of equity funds which happen to be named for their investment objectives. The first of these is aggressive growth funds. Funds in this group attempt to rapidly grow in value by investing in so-called hot stocks that are expected to jump in price. But because these stocks can drop sharply on the slightest bit of bad news, the prices of aggressive growth funds can go up or down like a roller coaster. Slightly less erratic are growth funds. These funds also try to raise their net asset value, but by focusing on the stocks of companies with above-average earnings growth. Growth and income funds are for those who can wait for their fund's asset value to rise, but who want to collect some money in the meantime in the form of cash dividends. They do this by investing in the stocks of well-established and profitable companies. Among the most conservative stock funds are equity income funds. Their aim is simply to bring in as much income as possible to their holders by investing in companies like utilities that pay big dividends. Equity funds seem to get the most attention in advertising and from the media, but in recent years, more dollars have actually gone into bond funds. As a result, there is now a fund for virtually every type of bond imaginable, as writer-correspondent Kevin Smith reports.
No offense, Don, but we're talking about buying out RJR Nabisco here. We're talking astrobucks.
Corporate finance may not seem to be Hollywood material, but in HBO's acclaimed television movie, Barbarians at the Gate, based on the leveraged buyout of RJR Nabisco, the sale of junk bonds was the secret weapon that funded the takeover. RJR holdings and similar junk bonds are among the many issues included in high-yield bond funds like Franklin's. Junk bonds pay more interest than other bonds because they're riskier and lower rated. But there are bond funds for virtually every type of investor.
If you're strictly looking for income, the municipal bonds and the government funds are going to be the best area for you. If you're looking for more of a combination where you have the ability to grow as the company's credit improves, the higher yielding bond funds would be appropriate for you, as well as the global bond funds.
Here in Franklin's tax-free bond department, traders deal in municipal bonds, which often have lower yields than other types, but can avoid taxation of the income at state and federal levels. But such bonds can go sharply up or down in price as interest rates fluctuate.
The double-digit gains registered recently by many bond funds could well be a thing of the past, as interest rates may start to rise again. But experts say there are still a lot of other good reasons to include bonds in your portfolio.
To be disappointed that you only got 7 or 8% in a given year where inflation was 3%, you actually increased the value of money 5%.
And some warn against investing in certain types of bond funds when interest rates are at or near bottom, because there's not a lot of room for bond prices to rise and substantial risk that prices could fall. Is it better to invest in a bond mutual fund rather than buy individual bonds? Trey McPhee wanted to find out. He helps manage a family trust fund, which has $3 million in individual tax-free bonds. Because McPhee has time to keep track of the investments, the conclusion here is that it doesn't make sense for him to switch to bond funds, which usually charge annual management fees of between 0.5% and 1% of a portfolio.
And I show currently that there is a 0 share balance.
But experts say, for those who are less sophisticated or have less time to oversee their investments, the diversification and professional management offered by bond funds can more than justify the fees, making them useful for those heading toward retirement or planning someone else's future. Kevin Smith of Reuters for NBR, San Mateo, California.
As we noted, the third broad area of mutual funds is money market funds. These funds hold short-term securities exclusively and are generally used as parking places for cash. But financial journalist Alan Levine says different types of money market funds have varying degrees of risk.
The riskiest funds, for example, own commercial paper, which are corporate IOUs, Yankee dollar CDs, which are CDs of overseas banks. So you have an extra layer of risk. The safest funds invest in T-bills.
Short-term government paper.
That's right.
Now, money market funds may be all right if you're just looking for short-term returns. But what if you're investing for a long-term goal, like retirement or college? In that case, which fund should you be in? Author Diane Voyevich has an unequivocal answer.
Any kind of stock fund, and the more aggressive you can be, the better off that fund, because time is on your side when you have 20, 15, 10 years to invest. Stocks are really the way to go, and they have been historically.
When you think of it, mutual fund companies are really service organizations. Your fund serves you by doing everything from making investment decisions to keeping financial records. But service costs money, and you pay for a fund's cost through a variety of fees. The most basic type is the fund's management fee. Although all funds charge this annual fee, which usually runs between 1% and 2% of the amount you've invested, you'll never see a bill for it since it's automatically included in the fund's net asset value. Some funds have another charge that's calculated into their NAV called a 12B1 fee. This annual fee is often used to pay for a fund's distribution costs, such as advertising expenses. Although a 12B1 fee can be as little as 0.25%, it can go as high as 1%. If you buy your fund through a middleman, like a stockbroker or insurance salesperson, you may be subject to a sales charge known as a load. A load is deducted from the amount you put in or take out of a fund, and it can range from under 4% to as high as 8.5%. A load charged when you buy your shares is called a front-end load, and if a load is charged when you sell, it's known as a back-end load. Some back-end loads go down and even disappear if you hold the fund for a certain length of time. Funds that don't charge loads are called no-load funds. So, are load funds worth the extra cost?
Yes, they are, Paul, because with a load fund, the sales charge pays for the advice of the broker. The broker will sit down in a face-to-face relationship with the client, help him establish his investment goals, help him determine his risk tolerance levels, help him make an asset allocation of different funds, and then through a lifetime of relationship, help him fine-tune and adjust the investments as they go along, and he's there to answer questions.
I think there's a large group of people who have no interest in finance and simply want to hire an expert, and for those people, I think the load is appropriate. But I think for people that even with a slight interest in investing, those people can go no load and save themselves a tremendous amount of money.
A major brand of gasoline once used the slogan, "Performance counts." And for any mutual fund investor, performance is also the top priority. For this reason, on the Nightly Business Report, we list the top performing mutual funds in several categories. The numbers we present measure the total return of the leading funds over certain periods of time, such as the past quarter, year, or 5 years. Although past performance is no guarantee of future return, it is still one of the best yardsticks for judging how a fund is likely to do. But what time frame should you use to measure a fund's performance?
If you had to pick one time, we would probably recommend 10 years, which obviously doesn't work for some of the newer funds. But I think for a fund that has a 10-year record,
you really need that long stretch of time to see how a fund behaves in different market conditions.
A simple way to do it is to just look at the annual returns. And if you go through and you look at the calendar year returns, you can get a good sense of how variable the fund's returns have been and how consistent. Two funds might have the same long-term performance record, but they may have arrived there via very, very different routes.
While a fund's performance is important, your satisfaction may also depend on how well it services your account. To demonstrate that, Chicago correspondent Diane Estabrook reports on what happens behind the scenes at a typical fund after you make a purchase.
Thank you for coming into the office.
You're welcome. For Matty Borowski, the decision to invest $10,000 in a mutual fund begins with a visit to Richard Haskell, an investment consultant at Kemper Securities in Chicago.
If it's all right with you, we will add to your corporate bond fund. We'll put that order in.
Okay.
You'll receive a confirmation, and you can send us the check in 5 days.
Haskell fills out an order ticket for the mutual fund, which includes information on the amount of money invested and whether dividends will be paid or reinvested in the fund. The order ticket is then taken to an order entry room. Here, an operator places the order on a computer. But at this point, the transaction is temporarily put on hold until the fund's net asset value for the day is set. At the end of the trading day, the fund is priced at $8.51 a share, making it possible to calculate the number of shares Borowski is buying. That information is placed on Borowski's order, which is then sent to Kemper Service Company in Kansas City for processing. If Borowski chooses, the service company can replace the broker as her primary contact with the fund and provide her with updated information about her investment. With a simple telephone call to this office, she can also arrange to sell her shares at any time. Kemper has about 2.5 million mutual fund accounts. On an average day, the company is likely to field anywhere from 5,000 to 6,000 phone calls on those accounts.
Thank you for calling Kemper Service Company. My name is Steve Wiedemann. How can I help you?
About 60 share owner service representatives are available here to answer investor questions, and that goes up to over 100 if there's a crisis like the stock market crash in 1987. The day after Borowski placed her mutual fund order, a customer service rep looks for confirmation of the order on a printout. A confirmation letter is sent to Borowski, becoming the first of many communications she will receive as a fund shareholder. Diane Estabrook, NBR, Chicago.
Because the stock and bond markets tend to move in cycles, there are those who contend that mutual fund returns can be magnified by a practice called market timing. This calls for the investor to get out of funds when the market is considered ripe for a drop. But financial advisors disagree as to whether it makes sense for the small investor.
Ever since 1932, we've had a bear market every 6 years on average, with a loss of about 34.5% on the S&P 500. Those losses, those bear markets, on average, it took 18 months to get from the top to the bottom and another 3 3/4 years to get back up to break even. That is beyond the patience of most investors.
I think basically people should adopt a buy and hold strategy. As he said, 1 out of 6 years roughly, there's a bear market. That means 5 out of 6 is a bull market. And the problem with market timing is simply it's virtually impossible to determine the direction of the market.
Although the government has certain reporting and accounting requirements to protect mutual fund investors, it does not insure mutual funds. So investors are pretty much on their own if their fund loses money. For that reason, the nation's top mutual fund cop says it's vital to understand the risks of whatever fund you're going into.
I think we've got to do a better job of educating the American investor in terms of opportunities and risks in the mutual fund field. The investors must first of all understand their own requirements and then be able to determine in a very hard-headed, forceful way exactly which fund is right for them and what are the opportunities and what are the risks in that fund.
As we've seen, there's a lot to consider before you buy any mutual fund. But before you make a purchase, be sure to go through an important document, the fund's prospectus. It will tell you many relevant facts about the fund's objectives, management, and track record. Remember, as with any investment, it doesn't hurt to know too much about a mutual fund. And if there's something you don't know, ask. I'm Paul Kangas, wishing you the best of mutual fund buy.
Nightly Business Report is produced in association with Reuters, which provides real-time and historical market data, news, and analytics over Quotron Advantage AE. And is made possible by A.G. Edwards, helping to build your financial future with comprehensive trust.